Hello, YouTube. Is the bear market back, and is it time to sell everything because we're seeing an everything sell-off in the last 1 week? Almost everything is down except for Amazon. So that image we showed at the beginning of the video really shows us that there's been a very repeatable pattern going back to 2022 when the bear market really started, that every single time we've had a very repeatable pattern here. We're going to go through that today to see if we can get a better clue on what could be happening over here because the bear could be back. So if that's the case, we want to be very mindful of that. We're also going to give an update to the weekly chart we pointed out last weekend, where we were looking for the test to the Fibonacci retracement, the hollow candle versus full candle, and the lower low being a warning. So stay tuned. I think we have a great show for you today. So at the essence of what we're talking about, we're trying to know whether or not we're going to get a shallow dip or a flattening out, or if we're going to go into a full-on bear market. And that's what we put at the in the title of the video. So it's going to be very good for us to go through and get an update here. So shallow just means that we kind of stopped going down right now. The opposite is that we're going to go down a lot more. We have a five pattern cycle here, where currently I think we're in number 4. And if we give an update to this really fast, we can look here and just note that for number 4, we can note here we're going back to the consolidation pocket now, that blue box, and we're set for our current first green month. So if we look at the note here, we crash line on the blue line, we dead cat bounce back up with 5 hollow candles or 5 expansions. Then we break through the number 1, and then we consolidate. So what that would lead to would be not only a retest of 432 on SPY or roughly 4,300 on SPX, it would lead to us going lower, putting in 2 red candles. And then if we're going to go into a bull market, that's the breakout. So we're looking for a potential shallow, but this weekly chart is already telling us to be mindful of that monthly pattern. On the flip side, we could be putting in a seasonal dip where we just really go sideways. So let's try to make sure we understand all of that today. So fired up traders get burned in the everything sell-off, which is what we talked about. So fixed income and commodities still managed to cough up their second worst week of the year. So what does that mean? It means that the market has priced in a lot of optimism and become too exuberant at a time of still uncertain environments and economic deceleration. Blah, blah, blah. There's been a lot of hype in the system lately. The Fitch downgrade was an excuse to sell. Excuse to sell. One more time, an excuse to sell. So that's what we put in the title of today's video. So please make sure to let me know what you think. It's also important to note that we've fallen out of extreme greed back into greed, and we've been bouncing around. We were flirting with it on Friday. On Thursday, we were at 74, but this was one of the telltale signs I said that I would need to see for us to signal we're going to be going lower. And if the timeline shows us here, well, we had a period where we had an ascending triangle, and now we got those lower lows. We actually dipped all the way down to 58. So that is a lower low versus the 65, and another piece of the recipe which is materialized. Now here's the conundrum. Last week, retail perfectly called it in opposite fashion, where they thought that we were going to go up for the first week going back to July 3rd. So the last time we had a red week, it's right here. That's the last time this indicator actually flipped to being bullish. So let's look and see if there is a clue here. So going back to July 3rd, that's the last time they thought that we were going to be going up. Sure enough, we went down. So I think that if we try to give an update here next week, we could go down. Right now, that's a pretty high reading. It's 2 out of 3 people. And what that would basically mean for me is that maybe on the seasonality chart, if we look really close, we might be due for a bit of a bounce here, where we get that bounce and then maybe we go lower after, which would basically mean a dead cat bounce. If we now look here to a 1-day chart and we put that candlestick into a line chart so we can try to see what that seasonal chart shows us, just bear with me for a moment here, because I just want to show you what I am seeing. So we're just going to delete everything for a second here. We know we have 1 cut, 2 cut, and we come back to the relative high. Okay, do we understand what that's showing us here? So we get 1 cut, dead cat bounce, 2 cuts, back down to the relative high going back to July. So that's the relative high we have right here. Okay, that seems like pretty simple. So it kind of looks like the initial target's been met, where if we're going to turn into the big bear, well, we probably have to hit this 50 DMA and then probably need to reject on it, forming what? Some kind of head and shoulders here. So that's basically what I'm looking for. I don't want to overcomplicate it, but I just want to make sure we're providing an update, because that is how we can go lower. So the pattern we talked about, we're going to update you on that in a moment. But I'm going to ask you for a huge favor before we go further. If you could please consider smashing that thumbs up and subscribing to the channel, I would greatly appreciate that. We put out stock market videos every single day, and we would love for you to be a part of our community. All right, so we talked about the hollow candle. We'll come back to that in a second. The five pattern recipe, which right now we're on number 4. So the cake looks like it's getting baked pretty well, and now we have to just take that bun out of the oven. Are we going to go to all-time highs after 2 months of consolidation, or are we going to fade? And whether or not retail is right. So I think that they might actually be right this week, but I think that they're going to get some pain first. So that means that the dead cat bounce happens, and then we go lower after. What's also really ironic this week is that we have the slope of hope and the wall of worry. So right now, performance chasing is what we talked about in the article for the everything sell-off. That's kind of what I'm noticing here. So if we pop over here to XLK on a 1-month chart, what do we know? Well, we've actually gone to new highs. So this is a pattern we've been tracking a little bit closely because it shows us that as we try to digest the previous all-time high, there's usually some indigestion, right? Some consolidation. And we can look no further than the DAX to see that. The market that went to new all-time highs first. And we note that it wasn't just a straight line up. There was at least a month or two of consolidation. So here's our previous top. Here's that retest and a new all-time high. We battle it out for a little bit, and then we're not sure right now, actually. So the DAX is Germany, and that's the closest equivalent to the US market in Europe. So a market we try to track a little bit closely because it's a very good clue sometimes. Let's just go back to our last chart. Okie dokie, there we go. Let's go further. We talked about these alerts last week, and I'm going to try to give an update again this week. So normally we would keep this reserved for our members only. And again, if you want to find out exactly how I'm going to be managing these, you can join us for a 14-day free trial to trade with me. Literally 2 free weeks, which means that you can see the way that I'm positioned for these alerts, the way that I plan to buy more, and what's my active holdings by just clicking on this button right here. But anyways, this was a very good signal. We got the alert for PSQ at 1041, currently at 1058. And for SH, it came in at 1375, and that alert is that price is now currently at 1388, which means both of these alerts held. And if we get them next week, that is the simplest way for me to say that we're going to be getting that bear. So I mentioned I would come back and talk about the pattern now. The pattern's pretty simple. There's a few things we're looking for here. We're actually going to go here to hollow candles because what I want to show, actually, let's go to this chart here. So the first part is that for us to no longer expand, we need to put in full candles. Full candles just mean that we're closing lower than we opened. So when you see a lot of hollow candles, it just means we're going up. That's the simplest way to say it. When you see full candles, we're going down. And in every example here, let's go back to our previous chart. You see a lot of red candles. That's us going down. So the first part is, let me just go here, is we don't have a hollow candle this week, which means that the expansion's at least on pause. We would have to see a hollow candle next week to resume. And we also have a lower low. But one lower low is only a warning. It is not confirmation. So what's confirmation? Well, that's this right here. 2 lower lows. We have multiple red candles, and we're closing below candle lows, right? We're closing below candle lows. And then we start to stall out. So closing below candle low, closing below the candle low, closing below the candle low. Well, that's kind of what we did right here. It's exactly what we just did. So for me, the evidence appears to be getting stronger. We don't have 2 lower lows yet because we're going to have to wait all the way until next Friday to get that data point. But isn't it really good to get a sell warning like we did last week before the big sell-off happens when it's time to be ready? Absolutely. And when we look here to that Fibonacci number we've been talking a lot about for the S&P, that's 45127. Well, that's an area that we kind of lost into Friday. That was last week's low. We tried to form support on it. And ironically, QQQ rejected off that exact same area, or the 7-8% retracement, slammed right onto its same uptrend and closed below last week's low. So if tech is leading us here, there's an awfully big signal. And as we look to earnings in a moment here, I want to give an update to the ones that really got hit this week. So let's look at that heat map. And I want to go through the trillion-dollar companies in a moment. So specifically on Apple, I'll just preview that one here. So we look at the last week, Apple got hit pretty hard, down 6.5%. Why does that matter? Well, because Apple's the biggest stock in the entire market. And when I look here to its annual chart or a 12-month candlestick, it shows me a very easy pattern to understand here. We fell back below last year's high and the 2021 high. We got 182.13 and 182.94. We're currently at 181s, which means that's a yearly failed breakout if we do not reclaim it. I know it's only halfway through the year, but that's a pretty powerful slam here, right? That's a pretty dramatic drop. And by closing at the low of the week, that usually implies there's downside momentum, which is still trying to get released. So that doesn't look fantastic. Down 7% on the week. That's a pretty big drop for the biggest stock in the world. So anyways, we know the beat crew has been the crew that's been coming in for earnings so far this year. And as earnings start to drop off, we're going to note that the number of companies here that are meaningful to the S&P 500 are not really all that great. Not really all that meaningful. So you're going to note there's some meme stocks in here. There's some highly shorted stocks. So first of all, we got Palantir expected to beat. Not a company that matters to me. Maybe it matters for Kathy Wood. Walt Disney expected to miss. That's interesting. Alibaba expected to beat. All right, Rivian expected to beat. AMC expected to beat. Upstart expected to beat. Supermicro expected to beat. And we got UPS expected to beat. Eli Lilly expected to beat. And we also got Lucid expecting to miss. And that is it for this week. I think what's gonna matter more than the earnings are gonna be the economic data, and specifically a Thursday. Why? Well, because this week on Friday, we got the data that really moved the market. Average hourly earnings went up and the unemployment rate ticked down. So in this market, good data is bad and bad data is good. Why? Because of the Fed. And right now, oh my goodness, is the data strong. The GDP is currently at 3.86. That is a crush, and that'll be difficult to beat next quarter. So that's why I think the market took a cue to go down, or that excuse to sell off, as we noted in the article we went through at the beginning of the video. So this next week, as we look through to this economic data, I think it's really all about Thursday. That's it. So whatever happens in the first part of the week, this could either be an excuse for us to sell off, or it could be an excuse for us to rally. We don't have the estimate yet or the forecast, but if this comes in with a 2 handle, like 2.9, 2.8, man, that would be received pretty well by the bulls. So maybe that's why retail's wrong. Or maybe there's just a little bit too much air still in the bubble and we got to deflate it a little bit more to get down closer to that 50 DMA, which is not really all that far from here. So if we look from the high that we established down to the low, it's basically 4.5%. It's a dip. It's not more than that yet. But I want to show you one thing here that I kind of forgot to mention at the beginning that's coming back to me now. And I'll go through that right now. So let's pull up the seasonality chart one more time, because if it's going to be a shallow dip, no more than 5%, we start to really level off here. Oops, zooming in on the wrong screen. Let's get the right one here. Presto magic. There we go. Right here, we're looking for sideways. What would this mean? If we're not 100% done the second cut and we're looking to dead cat bounce, but put in marginal lower lows and rally up into the end of the month, what does that mean? Well, it's pretty simple. Let's go here to our daily chart and let's just draw it. Crash line on the 50, maybe bounce around a little bit, and then W to close the month though. So boop, 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 right? Put in some kind of W and then rally up into the end of the month, which means we're basically hugging that 50 DMA as it starts to curl up here. As the 50 DMA curls up, let's make it blue so it's easy to see. There we go. That's what would happen. Okay, well, if we close below the 50 DMA, that's a warning. Absolutely, it's a warning. Not only is it a warning, it's usually a signal of momentum change. So if we get 2 daily candle closes below the 50 DMA, that's usually a warning. And then 2 candle closes back above, a little bit of volatility here. There we go. There's our drop. We get 2 candle closes below. There's your inability to rally up. 2 candle closes below, start of a dip. So even inside of those weekly patterns we're looking at, there is a clue on the daily chart. It's by closing below the 50 DMA. So if we manage to close below the 50 DMA for 2 days in a row, the probability increases that we're going for the big bear. Right, there you go. We'll talk about a few more charts at the very end, but let's just get through the rest of this economic data. That's really what I'm looking at. It's Thursday. So whatever happens in the first half of the week, we have to be prepared that it could wash out by the second half of the week. And that is how we could form one of these upper wicks here. So if we just hide everything again, let's actually just delete it. Let's zoom in. The way we form an upper wick is that there's some kind of momentum during the week, but then it washes out or flushes, right? So bulls buy it up and then we wash it out. And we can note it turns into a bearish engulfing candle. I don't know if we're going to rally back up to get a new 52-week high, but even just getting some kind of candle like this, some kind of candle like this, would just mean that we're finding sellers where we would expect. So by opening at the low of the week, if we push up into the first half of the week and then close lower, that would form the upper wick, which is a telltale sign of rips that is being sold. Sell the rip, sell the rip, sell the rip. So let's just be very mindful of what the evidence tells us, not what our feelings tell us. There we go. Closing that out. And this right here is like on a precipitous drop. So the question is whether or not it's great that CPI is coming down, but is that fear and greed and positioning now starting to come off a little bit? Something I forgot to check before I hit record was that short positioning to see whether or not these bears are going to capitulate or if they are not. Interesting. So they actually reduced their positions to 200,000 contracts. So on the big crash this week, they reduced their position from 262 weeks ago to 200 now. Relatively speaking, it's still a very big short. It's the same as what we had in 2020. So they're equally as bearish now as they were during 2020, but they've been bearish for over a year now. They've been 200,000 contract short since roughly June of last year when that rate hike started from the Fed. So with a lot of blood out there right now, we want to know whether or not this is a buyable dip. Well, the first thing I would note is that if the trend is potentially changing, but we're still in greed, do you buy greed? One more time. Do you buy greed or do you buy fear? You don't buy greed. So it's nice we're getting a dip. It's not buyable for me yet because the sentiment has not yet shifted. So if positioning is now changing, but this has not come down at least into neutral, maybe down, God forbid, into fear. And if we look at the low that we established, I believe it was 58. So let me just get a quick check on that because 58, I believe, would be inside of neutral or right at the low end of greed here. Let me just see here. So we came down to 58, which is still in greed, but it's almost back to neutral. 55 would be back inside that neutral range, 45 to 55. So, right, the flash dip got people quite scared. So let's see what's going to play out here. Closing these things out, let's look at a few more quick charts. So let's close that one out. So Apple, pretty powerful slam here. Let's look at a few more weekly candles to see what happened. Because looking here to SPY, it's a lower low. It's closing below last week's low, but it's not a bearish engulfing. We looked at QQQ, it's a bearish engulfing. We have a higher high, we have a lower low, and we also closed below last week's low, which is a telltale sign of bearishness. And if we lose this current uptrend, there's room for us to backtest our breakout, which basically takes the trend that I have right here and a backtest. If not, potentially slamming all the way down to 335. Also important to note that we have the support here from the Fibonacci number at 350, and for S&P, that corresponds at about 430, which happens to also be the relative high that we put in going back to August. So there are going to be levels of support as we're going down. If we continue to go down, just be very mindful here because if you look at a 1 hour chart, look what happened off the blue line into the close, right? In 3 candles, right? They sold it off hard. 3 hours in a row, they just drilled it, pivoting off of that the Fibonacci area. So, right, we usually take the staircase up and the elevator down, and being below the averages on the hourly is a bad signal, but it is not yet confirmation. Looking back here to our weekly chart, let's just see if there's anything else which gives us clues, because gold actually closed not all that bad, only down by about 1%. And I think that's because the dollar actually closed up by about 0.3. And I'm still not sure if we're actually going to crack and lose that $100 on the DXY or the Dixie. I'm not sure, but the pattern tells us that we have a dominant head and shoulders. We've stopped going up, which means we're really going sideways between this box right here of roughly 100 and 106. So I'm watching the dollar for a big clue. We got the 200 MA, we got the 50 MA, we got a pocket of consolidation, we got a low, double bottom, lower low. We don't yet have a higher high. So I'm a little bit skeptical here, but I'm just watching it really close. If we jump down to ETFs, and then we'll finish off by looking at big tech, we'll leave it there. I'm going to ask one more time, please and thank you. If you could, please consider smashing that thumbs up and subscribing to the channel. Thank you so much ahead of time. All right, let's go forward. So next thing we got here is going to be RSP. And what do we have? We have a lower high and a lower low below the previous candle low. And we've also lost that August high that we just talked about on S&P at 432, which means equal weight S&P is now going to have to battle because there's been a lot of buying up into here. We're going to find out whether or not there's going to be another excuse to sell, and we actually get a red bar, which is bigger than these green bars. That would be a red flag for me. Looking to the Dow, bearish engulfing below the previous weekly low, still trending up, still bullish, but again, we're getting one candle, which could be the start of a pattern, or it could also just be a trap. Looking here to the IWM, bearish engulfing, but it is not below last week's low. So it's showing a little bit more strength here, but it does have a death cross. So put a caveat beside that one. We look here to SMH or chips, bearish engulfing weekly candle, but it is not below last week's low. Moving forward to ARC, bearish engulfing, power slam, down 8%. All right, NYA, lower high, lower low, below the previous weekly low. Not a bearish engulfing, but pretty bearish. Looking here to XLE, green. So energy is green, energy is bullish. There you go. That's the only thing that's been green so far. XLK, pretty hard slam. We got 179.05, 179.03. double top, lower low, closing below the previous candle low. And all of these are closing right near the candle low, which means there's usually going to be downside pressure building up and that wants to release as we go lower. That's how we could form that move lower next week. XLV, man, just a bear pivot, just slammed, blasted through last week's low, slammed right down to the 50 weekly. Definitely stock in a consolidation range, solidly going sideways for a very long time, but it's pretty close to all-time highs too. So let's just think about that. XLU definitely going sideways and right around those 2020 highs and the lows we've established here. So that's a pretty big candle too, down 4.5%. That doesn't look very good. All right, looking here to XLF, lower high, lower low, below previous candle low. Looks like it might be a cup and handle, forming a handle, but it's only a handle if we actually break to new highs. So we're going to have to watch for that one too. Still looks like capitulation volume, but we've not yet quite seen that move higher. The DAX, bearish engulfing weekly candle, and it is below the previous candle low at 16,000. So that's bearish. FXI, oops, let's go back to FXI or China. Man, coming off a really low base, battling to hold this 50 MA. We got BABA earnings, so let's see if I can actually drive it up or if it's going to get dragged down with the rest of the world. EEM or emerging markets, 41.96, 42, higher high. We got the lower low, but we didn't close below it. It's awfully close. It's off by about 10 cents. So that's pretty bearish too, down by 3.5%, looking to see if we can back us and hold that 50 MA. And then IAT or regional banks, ironically, one of the strong guys and one that I happen to own. So again, if you want to find out more about what my portfolio holds, join us for 14 free days and you can trade with me to see exactly what I'm planning to buy next week and what I currently own right now. This one looks pretty good. It has a hammer. It has a higher, it's roughly a double top, but it bounced off the low. So something ironic is happening here with IAT. I don't know what it is. Maybe we're talking about rates pausing. I'm not sure. We're going to leave it there. We're going to talk about the 10-year note to finish off. And what's it going? Well, it's going higher. So this was the, I think this was the one we talked about here where if it keeps going higher, that was the bear crash signal we talked about before as well. But it has to get to a new 52-week high. So if that happens, I will update on the bear next week. That's the thing I'll be watching for. Finally, let's get to these mega cap trillion-dollar, mega big stonks, magnificent seven, whatever you want to call them. 12-month chart for Apple. Let's see what we got. We're going to zoom in nice and close because we just want to see whether we understand what's really happening for support and resistance. So sorry for all the zooming in there. There we go. So I talked about Apple here. We are below the 2021 and 2022 low, which means if we're red next week, it means we're below the previous annual lows. Where's support on the annual? Down here at 140. It's a lot lower. Please be careful. Microsoft, same thing. Below, oops, let's go back to Microsoft. Second biggest company. It is below both years' highs, which means that's also an annual failed breakout. Same pattern we're noticing on Apple. Moving forward to Google, still room to move to the upside. It's been able to power up. It hasn't quite gone to those new all-time highs yet. So maybe BART is going to do that. Earnings were received well, but we have to make a move up. Amazon, very similar, tagged. But however, it tagged the 2021 low at 144. We made it to 143 on that earnings crush. Very close, but no cigar. Backing off to close just below 140. So if we can't power up here, that could lead to, if we can power up, it could get to roughly 162 or my next real body target. If not, there's lots of room to fade back down to about $100. NVIDIA, lots of room. This is still clearly our leader. It would have to drop by, it reports earnings later than the rest of the gang. So if we have a look here from where it is right now, it would have to drop by 20+% or have a bear market from the high. I mean, basically dropping 30%. That's a bear market. That's more for us to fall back below that 2021 high. Then we got Meta, looking really strong, to be honest. Looking here, we can note it's above the real, above the next candle. We're looking for 337. I think the chart's starting to max out. That's a pretty fat bar. Tesla, same thing as Meta, just got over that previous candle high, has room to extend here to roughly 350. And those are all the big stonks, everything you guys wanted. I think I covered a lot of things this week. Hopefully you feel prepared. But if not, we'll leave you with a video here which talks about that crash signal and the 10-year note we were talking about. If not, thank you so much for tuning in. And please consider joining us for a 14-day free trial at thealgo.com if you want to trade with me, Justin from YouTube. Thank you so much. I look forward to seeing you on the next video.